Good morning and welcome to today's webinar, the Corporate Transparency Act, Preparing Your Small Business. I'm Christine Kulamani, Managing Attorney with the DC Bar Pro Bono Center's nonprofit and small business legal assistance programs. As we get going, a tremendous thank you to my colleague, Lauren, who has done all of the behind the scenes work to get you registered, to make sure that today goes off smoothly, and to make this webinar possible overall. Also, I cannot say thank you enough to our presenter, Matt, a senior associate here in Washington, D.C. with Arnold Porter. Before we get started into the content, a couple of logistics for today's webinar. If you are joining us live, this webinar will be recorded. In addition, you have immediate access to the presentation slides in your GoToWebinar control panel under Handouts. If you have general questions as we go throughout the presentation with Matt today, please send them to us through the questions box, also in your GoToWebinar control panel. We'll try to get to as many of the relevant, appropriate questions as we can today. However, if you need legal advice, if you have questions that are specific to your business's unique situation and circumstances, you can sign up separately after the fact to receive brief legal advice through our Small Business Brief Advice Legal Clinic. Okay, with that out of the way, on to today's topic, the Corporate Transparency Act. I'm going to skip the background and the purpose and the context for this new federal law because Matt is going to cover that and he's going to do a much better job than I ever could. So with that, I'm going to turn it over to you, Matt, and thank you again.
Yeah, of course. Welcome, everybody. I'm going to turn my camera off in a minute as we get started, not to distract everyone, but feel free to interrupt and put questions through the chat at any time for clarification, or we can probably have a Q&A at the end as well. All right, let me turn my camera off here. Okay, so the Corporate Transparency Act is a new statute that came out of some legislation back in 2020. And today we're going to cover, a description of what it is, figure out who is required to report, what they're required to report, when you have to do it, how you have to do it, and then what happens if you don't, with some tips and other kind of things along the way. All right, so as I was saying, the CTA, which I'll call it for now, the Corporate Transparency Act, is part of the Anti-Money Laundering Act, or AML, and really has a focus on basically the use of shell companies, the use of LLCs, corporations, that are really intended to hide the ownership of the company itself. And people may have seen things in the Wall Street Journal or New York Times or other articles about shell companies that would either hide foreign money or buy expensive penthouse apartments in New York. And I think it kind of originated from concern that it was really hard to figure out who actually owned and benefited from those entities. But obviously there's no way to only ask that subset of entities to report, so they went ahead and created kind of a much broader beneficial ownership reporting framework. Let's see. So one thing to note is that the CTA is actually specifically focused on small business, which seems odd because normally you don't have regulations that target small businesses in particular. And I think that the rationale behind this is, look, if there are a large public corporation or what have you, it's pretty clear that it's either owned by the stockholders or it's a private family company and we know who they are. But if we're looking at things like a single LLC buying an apartment in New York, as I mentioned before, it's not going to currently be subject to kind of any reporting or regulation. So when we get into exemptions, you'll kind of see this more clearly, but the idea is basically that it covers everything and then carves some stuff back, and what it mostly leaves is small businesses. When FinCEN, which is a bureau of the Treasury Department, came out with these rulemakings to kind of describe how this worked. The statute itself is only 5 pages, but it took them 100 pages of small, dense text to kind of explain the how, what, and why of it, was supposed to work. And in that they do impact studies on small businesses and say they're focused on helping small businesses, but then they kind of admit that there's really only so much they can do, because the entire point of this is to sweep up small business reporting information. And so other than making it work seamlessly, it's not like they can kind of create exemptions or do anything like that. All right. So under the Act, it's something called a reporting company is the only entity or person required to actually submit something to FinCEN. And so the Act basically has to describe them what a reporting company is. They describe it as basically any entity that can be created when you make a filing with the Secretary of State or similar office. And so what that means is if you, go to old DCRA and now DLCP and form a corporation, form a partnership by filing a form with them, that is exactly kind of what makes you a reporting company. And as we'll talk about in a minute, it doesn't matter whether you're already in existence or forming in the future, except for timing. You're still a reporting company. After LLCs and corporations, it gets a little bit murky, because they put out these rules and people asked questions, and they didn't really get, they being FinCEN didn't really give perfect answers. And so there's some ambiguity right now on whether partnerships, limited partnerships, limited liability partnerships, et cetera, are subject to this Act. And the reason for that is because of the definition above where it says created by, and you see that's bolded. There's an argument that in many states or in DC, you don't actually form your partnership by filling out a form with DCRA. Instead, what you're really doing is telling DCRA about a partnership that already existed. And that's because kind of partnerships are this older common law concept where, LLCs and corporations are more statutory. And it totally depends on the state. And I think most people will just go ahead and assume that, at least for limited partnerships and limited liability partnerships, that you better, still file to be safe. We'll have to see how that shakes out, if there's further guidance given on that point, but that's a bit of a gray area. But notably, one of the things that the rulemaking does say is that sole proprietorships are definitely not subject to the Act. And then, general partnerships, common law general partnerships, especially where you don't actually file anything with DCRA. But if you have, a simple general partnership agreement with the co-owner of your business and don't have a separate entity, you don't suddenly get pulled into the definition of a reporting company.
Matt, before we jump into exemptions, looking at that definition you just gave us of reporting companies, and that they are an entity created by filing that document here in DC with DLCP or formerly DCRA, would that include cooperatives?
That's a really good question. I would probably put cooperatives, and I would have to do a little more research on this, but I would put that in the bucket of limited partnerships and limited liability partnerships, where the Act is not specific, and therefore it's kind of in a gray area. And so what the Act did is said, look, in every state that we've checked, an LLC and a corporation, you have to file something in order to form it. You can't just have an LLC that you claim is an LLC without forming it. cooperative strikes me, or like an unincorporated association, which you might have in a condo building, something like that, is much closer to something where you're giving the jurisdiction a heads up that this kind of pseudo entity exists without necessarily causing it to be created. So it's probably in that same gray area bucket, but I don't recall seeing anything in the rulemaking about specifically about cooperatives.
Okay, thank you. And, I think we just got a really great question that, brings up some of the distinction between corporate law and tax law. So here we're talking about LLCs and corporations as entities, legal business entities, legal persons. And to clarify, is it correct that here we are looking at businesses that are an LLC or corporation separate from whether they are taxed as a sole proprietor or a partnership?
Yeah, that's a really good point. So that's a really good question. The rulemaking is clear that if your LLC elects to be, or no, you don't even have to elect, I guess by default, if it's a multi-member LLC, it's taxed as a partnership. It's still considered an LLC. And if it's a single member LLC that's, disregarded for taxation purposes because it's only got one owner and you just file it on your personal taxes, it's still an LLC. So that's a really, really good question. But yeah, unfortunately, you're still kind of caught up in the act.
Thank you so much, Matt. That is it for questions, right?
Okay, great. 1 second. Okay. All right, so I'll touch on the exemptions quickly in that most of them are unlikely to apply to a lot of the people on the call without knowing fact-specific things, but they're typically aimed, as I was hinting at before, at entities that are already subject to some type of oversight. So, the bigger examples are, registered investment advisors and publicly traded companies and banks and things like that. There is a category called large operating companies, and which to me is a bit of a misnomer because the thresholds for being a large operating company are actually below what the SBA considers a small business in most industries. And so it may very well be bigger than a lot of the attendees of the call, but I think it's worth talking about, which is that if you have a physical operation in the United States, you have at least 20 employees, and you generate $5 million in revenue, not profit, but revenue or sales, that you qualify as a large operating company and you're exempted from the act. To me, it's not entirely clear why that's the case, given that even as this quote unquote large operating company, you're not subject to other obvious reporting requirements necessarily. But that's one that could be considered. And the other one that is worth mentioning that is not on the slide, that I just thought about at the beginning of the call, is that 501c3s are similarly exempt. And so I don't know if there are any nonprofit attendees on the call, but nonprofits that are operating as 501c3s are also exempt. Okay, so the last point on this is that if you are an exempt entity under most of the categories and you have a subsidiary, that subsidiary is generally also exempt. So that's kind of also worth considering if you had, a different LLC that ran a different part of the business but was fully owned by your main company. Okay, so a reporting company is required to basically tell two things. One is who are the beneficial owners, and we'll get into what that means. And the second is who are the company applicants. And I'll start with company applicants actually, because it's a bit simpler. And the easiest way to think about this is whoever really set up the entity. And that could be if you used a formation service like a CSC or an NRAI or a CT corporation that did the formation for you. The company applicant is literally going to be some employee that you've never heard of that company. And so one of the tricky things is, as we get into the reporting requirements for new entities that were formed, because you don't have to report company applicants for existing entities because they figure that ship has sailed. So if you're doing it for a new entity and you're getting assistance from either a law firm or a pro bono clinic or whatever it is in setting up your company, you need to get the minimum information about who the company applicant was, so you can report that with confidence. The company applicants are mainly there as an additional contact in case there's ever an investigation. And so by becoming a company applicant, you're not necessarily exposing yourself to any kind of liability per se, but if there was ever a question about the entity or what the formation was like or things that happened around it, they want to have the name of the company applicant and the address and the phone number so they can call and say, hey, what was going on with this entity? The other category, and the more substantive category, is the beneficial owner. And despite being called a beneficial owner, it's both an ownership and a control test. So if you exercise substantial control, and it's defined, and we'll talk about it, over the reporting company, you're a beneficial owner. If you own at least 25% directly or indirectly of the reporting company, you're a beneficial owner. And there could be, presumably, if not unlimited, at least a large number of beneficial owners, where we'll talk about this a little bit more in detail in a slide or two, but if you imagine a situation where you have, 3 or 4 senior managers and 3 different people who each own 30% of a company, then all of a sudden you have, 7 beneficial owners that you're reporting. So taking a look at this a little bit closer, the substantial control test is if you're a senior officer of the company and they give examples of what a senior officer is, but don't say it can only be those things. But the examples were like general counsel and chief executive officer. And so one of the things we've been noting to people is you're going to have to be a little more careful about the titles you give people if there's a concern that they don't want to be reported. If you're giving someone a title of chief operating officer and they otherwise could have just been called a vice president, or whatever other neat corporate name you want to give them, then all of a sudden maybe they're not a beneficial owner for reporting purposes. So other substantial control is appointing or removing other senior officers or directors on a board of directors, or making important decisions. And they give all these examples of important decisions and then have kind of broad catch-alls too. But the idea is basically, if you're controlling what the company does from a common sense perspective, you're gonna be a beneficial owner. And so important to know, because we've got this question before, which is, well, what if no one owns more than 25% and no one really fits these strict definitions of substantial control? And the rulemaking kind of goes out of its way to say, look, there's always going to be one person at the very least that's exercising some control over a company. And so even if you're not meeting the ownership requirements or something else, just you have to file at least one person. All right, so beneficial owner guidelines exempt some, minor children. The most interesting one is employees, but it's only if they're acting as an employee and not as the senior officer, which is kind of, again, a little bit tricky. But going back to the example before, if someone's acting in their role as, a vice president or whatever the name is that maybe or maybe not isn't considered a senior officer, and they don't really have an ownership status in the company, and their control is purely based on their employment, and that if they were fired tomorrow, they wouldn't have that control anymore, that person would most likely be exempt. And then creditors are exempt as well. It's not really something you have to worry about, but if you have loans from friends or family or a bank, you don't have to report them as owning the company, even if they kind of have rights to tell you what to do. And so the Act recognizes that a lot of creditors are going to have some rights to say, well, we don't want you turning around and loaning the money again to someone else. We don't want you completely changing the purpose of your business overnight. That doesn't necessarily give them control in the sense that they're now an owner. All right, so contents of reporting. The reporting company, it's not a lot, but it is what people would typically think of as being confidential or sensitive or private information. And so with the reporting company itself, you have to do the legal name, any trade names, the address, where it was formed, and whatever the taxpayer identification number is, whether that's your EIN, whether it's if you're a disregarded entity and you're using your social security number, whatever it is that the IRS uses to identify you, you have to give them. And part of the reason for that is that there is a theory out there that they're going to in part cross-check compliance with this law by looking at tax filings or EIN requests or things like that, in addition to obviously looking at state filing records or bank loan disclosures. Like if you're telling your bank X, Y, and Z, that information can be cross-checked against the database, but definitely tax records as well. And in addition to the information about the company itself, it also, as we were talking about, has to disclose the beneficial owners and company applicants. And so for those individuals, and it's always going to be individuals in this category, you don't, a beneficial owner is not just a parent company. You're always looking for and up to actual individuals, warm bodies. And so you're giving some personal information, your home address, your date of birth. You have to basically scan a picture of your driver's license or passport. So there are things in here that generally seem to make people a little bit uncomfortable, in part because of all the data breaches that have gone on and things like that, or just kind of a general discomfort doing this. But right now, these are what are required. Okay. So there's a distinction, as I mentioned, between existing entities and newly formed entities. When I say newly formed, I mean formed after January 1st, 2024, which is officially when the law comes into effect. Right now, it's just purely the law has passed. It is live, but it doesn't actually cause anything to happen until January 1, 2024. And so if you are forming a new entity on or after that date, you basically have 30 days to comply from when your entity is formed. So if you decide to start a new business or a subsidiary or whatever else on January 3rd of next year, you go to DLCP, and I know LLCs are instant online now, so you literally get your formation 5 minutes later, whatever it is. You have 30 days from that point to submit all this information to FinCEN. However, if you have an existing entity, which I'm assuming most people on this call have, you don't actually have to comply or do anything until January 1st, 2025. So there's some breathing room built in. And as I mentioned before, company applicants are not required to be reported for companies that are already in existence on or before January 1st, 2024. So you're really only reporting beneficial owners, in a year and a half or whenever this becomes active. Okay. Updating initial reports, same kind of thing. You have 30 days from finding out information was either incorrectly reported or it changed or whatever it is. And unless you were totally wrong about the company applicant information, you don't have to change it. So like, you don't have to track down if Jane still works at, corporation services company and update her home address every time she moves. The company applicant information is what it is on the day you report, unless it was wrong. But on the other hand, if you have a new owner coming into the business, if someone who previously owned 20% of the business now owns 30% of the business, if you hire a new CEO, any of those things, you have to be cognizant that there's this fairly short time period in which you then have to turn around and report all of this information back to FinCEN and say, hey, this changed. Okay, so the idea is that all of this information is going to get submitted online to something called the Beneficial Ownership Secure System, or BOSS. No one has seen this. No one knows what it looks like. No one knows what the forms are going to look like. No one knows what type of information it might ask you that might be a surprise based on how the act was drafted. There's pure speculation, and it's truly speculation and not anything that is more than that, how could they possibly design this whole system and test it and have it up by January 1, 2024? Maybe there's a chance the law gets postponed. And so I think you have to assume that they're going to have it done on time, but no one has seen anything about this, and they're still doing rulemakings to figure out who has access to it and what they have to do to get access. So obviously, government investigators, were they to be looking into money laundering or fraud or whatever else, are going to have kind of free use of the database. But there's questions about, do state formation offices get to look at it? Does your bank get to look at it to cross-check what you're telling your bank? And so if you report to your bank, here's my org chart, and X, Y, and Z own 25% each, but you had previously reported that, 3 different people were the owners, is a bank going to be able to go cross-check that? The assumption is yes, but that's still all getting worked out. Okay. So the penalties for failure to report can be pretty strict. If you look at the bottom, there's a $500 a day fine, which caps that at $10,000. Or there can be criminal penalties, including an up to imprisonment. So they're taking this seriously. My guess is that those stricter penalties are for people who were actually committing fraud and violating the AML, and it's just one additional law that they can say they were violating. And again, the jumping back up to the top here, the standard is kind of willfully misleading, willfully providing false information to FinCEN. So it doesn't define willful, but the assumption is that it's a pretty high bar. So if you never heard of the CTA and just didn't file anything, it strikes me personally as hard to say that was a willful, violation of the act. But if you know that one of your 50% owners is a very private person, and just to simply decide, I'm just not going to report them, they don't want to be reported, I'm just not going to report it, that starts to get a lot closer to kind of willfully misleading the government. So the question then is, obviously the reporting company is the entity that has to do this filing. So who is liable if any of this comes up. It's not necessarily going to be the company, although companies can face, civil and criminal liability, but it goes beyond that, and it basically says any person who causes the failure. And so if you are a senior officer, if you are someone who's in a position to know, and you're basically causing the company to submit false reports, then you're in that bucket of being personally liable. And so, this is something to consider with, if you have, for example, say you had a partnership with another family, and in your limited partnership agreement or your LLC agreement, their interest, their 50% interest, call it, is held by yet another company. It's held by another LLC, and they tell the main company that for purposes of reporting, their 50% LLC interest are actually owned by 10 different people with only 5% each, and therefore no one falls over the 25% threshold. If it turns out that that's not true, and there was one 50% owner, one 30% owner, obviously they would be liable, or potentially liable, for causing a willful failure to provide false information. What people are a little bit nervous about is this line that says, if you're a senior officer of the reporting company at the time it happened, you could also be liable. So if you're the CEO and your partner is providing you false information, it's a little bit ambiguous what might happen. And so one of the things people are trying to consider is, if I'm going to do a partnership with someone, if I'm going to take investors, and the investors are going to own a large chunk of the company, 40% of the company, what kind of representations or guarantees can I get from those investors or those partners that they're going to accurately tell me what I need to report, so that we're not, falling afoul of the statute? Okay, so this is actually kind of started where I started to head, but so as a small business, you're probably not going to have a manual or, a long paper that's filed with the company on how to comply with this. It's more going to be being aware, so that when you form a new entity or have to report on your existing entity, or your partner, passes away and their interests go down to their kids, whatever it is, you need to at least be aware that those are things that are going to kind of trigger a need to think about this a little more, possibly to report something. And so there should be at least some kind of basic internal protocol for figuring out how to handle all this. The other thought is that because all of the penalties are for willful violations, maybe it'll help if you can show that you had a policy about this and you tried your best. And so that if you're a senior officer, it wasn't kind of willful ignorance, you did your best to try to get everyone to report honestly, and it didn't happen, and it's not your fault. So kind of like a little bit CYA, just having, evidence in place that you tried, that in good faith you wanted to comply with the law, could be important. And then, if it's, again, kind of more with the policy thing, but sticking with the the partner, or really any owner of a company, as an example, if you move, if you're doing estate planning and putting interests in trusts, whatever it may be, there needs to be kind of an ongoing obligation that the company be told about all of these things, so that it can figure out whether reporting needs to be done or not. So some of you may be aware of or have seen that DC actually a couple of years ago had a very similar act. It didn't go nearly as far, but it had the same kind of intent. Unlike the federal one, the DC one was mostly focused on owners of kind of slum type properties, in that the district had kind of a big problem with people owning, very not safe, not repaired housing stock in the city. And when they were assessed with violations or tried to be sued by the residents of the attorney general, it was just, there was such a tangle of entities in these organizational charts that it kind of became impossible to figure out who's really to blame, who really owned that apartment building. But again, because you can't really limit it to a specific subset, the same way the federal government went broad, DC went broad and just made it apply to kind of every entity no matter what. And the exemptions in DC are much smaller. We're not going to get into them really, but the idea was that, like the CTA, you have to report your beneficial owners and anyone who kind of controls the entity. And you're giving the name, the residence, and the business address of those people. You don't have to give the same level of personally identifiable information. You're not giving out social security numbers. You're not copying licenses into a database. Although one of the interesting differences is that the DC version is effectively public. So if you go on to the DLCP website and look up a company, at least back when it was the DCRA website, I'm not sure what it looks like now. It was kind of confusing because they called, no matter who the kind of beneficial owner is, they called it a governor. And so there was like a little tab you could click and it would be like, the governor is blank. And what that governor was whoever was reported generally as the beneficial owner when the entity was formed. And so it's more public in DC because again, the federal database, it's not going to be something that your neighbor down the street can look at. It's really for finance and law enforcement and those types of users, where DC is at least slightly more public. It's a similar test. They're looking at whether you have 10% or more of the ownership interest in the company or the ability to kind of control important decisions or day-to-day operations. At this point, it's believed that both acts will kind of live on in tandem. I don't think I have seen anything to suggest that the CTA somehow supersedes the local provision, and so I think it's a fair assumption that you just have to comply with both, which again makes it tricky because it's slightly different ownership thresholds and slightly different language in the test. And I could come up with a hypothetical where you have someone who is a beneficial owner in DC but not a beneficial owner under the CTA. So just unfortunately another kind of confusing wrinkle to be aware of. All right, I think that's it. So we have plenty of time for questions if anyone has any.
Okay, thank you, Matt. That was both a lot of information, but very clarifying. So I'm going to go through some of the questions that have come in the past few minutes. Live listeners, if you have more, please send them in through the questions tab, and if they are appropriate, we will get to them. Okay, so first question, and this might be very foundational or fundamental, but we've had a few businesses listening ask, when they are trying to determine who beneficial owners are that own 25% or more of the ownership interest for federal purposes, how do they know who owns how much? Are there different corporate documents they can look to? Are there certain types of records that will give indications of who owns how much?
They being the reporting business, the company.
Correct.
Yeah. So generally, if we take an example of a corporation or LLC, a corporation, most corporations have shares of stock or some other kind of certificated interest, and so there should be, and there won't always be, but there should be a record in kind of the books and records of the company that, 100 shares of stock were issued to Jill and 50 shares were issued to Bob and, whatever else. And you can kind of just do the math. And, the assumption I think that the federal government has is that, it's your business. You should kind of have a general idea who you've given ownership interest to. And if there are smaller ones floating out there that, may have been given, by a parent to their child or whatever, as long as it's under 25%, it's really not a big deal. And if it's over 25%, you should probably know about it. So, from a corporate perspective, you probably just have to go back and trace the books. Sometimes in the articles of incorporation, you might actually list who the initial stockholders are, or you might list who the initial board of directors are. That could be a useful starting point. And then with an LLC, same kind of thing. Almost every limited liability company agreement I've ever seen has either an Exhibit A or a Schedule A or something similar, where it's literally a table and it says, these are the 3 or 4 members, and these are the percentage of ownership that each person has. And so where it gets a little bit nuanced is, especially in something like a real estate venture, something like that, where you might have 8 different LLCs all kind of owning interests in each other. And then the math definitely becomes a little more complicated, and you might need, an accountant or some kind of assistance in figuring it out. But you're supposed to kind of aggregate all the way through. So if there's, 3 different families have an LLC that all join in a separate LLC to invest in something, and you kind of really do have to trace ownership indirectly back up through all the other layers of the company and to kind of get to this ultimate question of who owns what. So the math should always be doable. I think the only question is if there's, some kind of record keeping deficiency, what to do about it. But, as I say this, the other thing that most people can do is probably talk to their accountants, because when you're in an LLC, people generally get these kind of partnership tax forms at the end of the year called K1s, and the K1s specify what interest everybody has. And so you could always look to what you did last year and said, oh, well, we gave, these 2 members K1s that said they owned more than 25% of the company. Even if I'm lacking this initial LLC agreement, for tax purposes, we've already reported to the government that these people are passing the threshold, so they definitely fall into that bucket.
So for business owners that are listening, if you're operating your business also, and you don't know who owns how much, you have some time to start, going through those documents and records that Matt was just talking about, so that when you do have to report, hopefully it's a lot easier. So speaking about, those different timelines for compliance that you mentioned, Matt, existing entities have a little more time, but, upcoming business entities that start after January 1st, 2024, as of right now, will have to immediately comply. Is there any advantage from your perspective for startup small businesses right now that have no entity yet? Maybe they're a sole proprietor, they're in the idea, but not yet taking things to the next level phase. Does it make sense to start an entity sooner rather than later strategically in order to delay reporting?
Yeah, that's a good question. I mean, if you form your entity on December 31st and effectively give yourself an extra 11 months to report, there could be some value in that. The downside to doing it is that there's always a cost to forming an entity and maintaining an entity. So that's an extra year of fees that you're paying to DC or to Delaware or wherever it is that you're forming. And so you just have to kind of weigh in your own mind, is it worth it to just not have to deal with this for a year to pay, you know, $300-400, whatever extra it costs to form the entity now?
Great. Yeah, that's some good food for thought for those of you that are in that position. Can we return just to the large operating company exemption and walk back through the requirements for that? We've had a couple of small businesses that think they may possibly be exempt under that, but they wanted to just have you walk us through that again so that they can really think on it.
Sure. And so this exemption is, you know, I think if something like a restaurant or, you know, a small taxi business or, you know, whatever it is, there's a chance that you could meet these thresholds. And so you have to have physical US office, not office space, but some kind of business presence in the United States. You have to generate more than $5 million in annual gross receipts or sales, and you have to employ more than 20 people. And as far as we can tell, you're not aggregating employees across entities, but you can, and it's something I actually need to look into a little bit more anyway, but you can, to some extent, aggregate the gross sales if you're doing consolidated tax reporting. And so if you have a group of companies that are all consolidating their tax returns and reporting taxes together, I think any of those entities is kind of deemed to have whatever the total is of those gross receipts. And so that's something that would be more fact specific, and you know, I need to look into it more as well. But you know, the easiest case would be something like, you know, a restaurant that employs 25 people and, you know, makes $6 million in a year, would kind of clearly fit into this bucket of a large operating company.
And we may not have an answer to this yet, but we've had some questions, so I'm going to throw it out there. Can a business change from being exempt to being required to report? And if so, do we know how often the business needs to reevaluate that?
Yeah, that's another really good question. And so the Act does contemplate in the update section that you very well might have been exempt and aren't anymore. And, you know, I guess, you know, for example, say you were a 501c3 and lost your tax exempt status, or if you were a large operating company and had to lay people off or had a down year. I don't think there is much cushion as far as kind of a buffer to report. You're still within that 30-day update bucket. And so if you're right on the edge of one of these exemptions, or if there's a scenario in your head where it could go away, you do need to be prepared to very quickly turn around it and comply with the reporting requirements.
Okay, Matt, that looks like we have addressed all of the questions that have come in. Is there anything that we have not touched on that you thought of as we've been talking that is really important for the business owners listening live or listening to this recording that they should know?
No, I mean, I think the only thing I'd say is that the FinCEN has promised and I think has funds for a certain level of small business outreach. And so it's definitely kind of worth keeping an ear to the ground as we get closer to the deadlines. And, you know, I think just by simply having attended this webinar, most people are probably light years ahead of what you would be if you just read the FinCEN's FAQ. So like, for example, like FinCEN just put out a general FAQ a few weeks ago that in my opinion was just kind of very weak, and didn't really hit the questions that most people would have. So I think as far as, you know, outreach to the small business community, my guess is most of it focuses on, look, this exists, rather than nuanced questions people might have. But you never know, they might answer questions about limited partnerships, or they might go into details, you know, that are worth knowing, because we're obviously either, you know, at least 6 months out, or 18 months out, depending on if you're a new or existing company. So there's plenty of time for them to clarify things.
Fantastic. Thank you, Matt, and thank you to all of our listeners for joining. Once I end this webinar in a second, you will be directed to a participant survey. So please share your thoughts there. And remember, if you would like to speak one-on-one with an attorney for free about your business legal questions or issues, view the Pro Bono Center's upcoming events, or take a peek at our online resource library, you can visit lawhelp.org/DC/NPSB for nonprofit small business, lawhelp.org/DC/NPSB. And thank you again, Matt, and thank you, Arnold and Porter, for letting Matt be with us today. We really appreciate the information.
Great. All right. I'll talk to everybody soon.